Hi everyone, it's Marissa and Matthew here from Rise High. Today we're talking about stamp duty and LMI. Let's start with stamp duty. Matthew, can you please tell us what is stamp duty?
Certainly. So stamp duty is a fee that's payable to the government when you purchase an existing property or a block of land.
Yep, so it's basically a form of tax, isn't it?
Correct, yes.
Yep. And how much stamp duty do you need to pay when you purchase a home or a piece of land?
Certainly. So the stamp duty, as we said, was calculated on the purchase price. So my recommendation would be to have a look on our website and go to risehigher.com.au. We've got a really good calculator section on there, and one of those is a stamp duty calculator, just as it's calculated different in every state as well.
Absolutely. If you want a rough guide, in South Australia, you're looking at about 5 to 5.5% of the value of the property that you're buying.
Yes.
But like Matthew said, great to go and do a proper calculation so you can get a more accurate understanding. Of course, we can also help to work out what your stamp duty payable will be. Can stamp duty be added to the mortgage?
Unfortunately, no, it cannot be added to the mortgage. So that's a fee that's payable that comes out of your deposit amount that you've got.
Now that's obviously in the case where you don't own another property, but if you had another property that had equity in it, then potentially you could add it to the mortgage, Matthew?
Yes, you could use the equity in that property to potentially pay the stamp duty on another property.
Yeah. And when is stamp duty payable?
So stamp duty is payable on the day of settlement.
Yes.
It's payable to the government, as we said, so something that the conveyancer will organise for you.
So some borrowers want to know if they can pay it later, but that's not really an option, is it?
No, it's not. It does need to be paid at settlement when you purchase a property, yes.
Another question that we get asked is stamp duty tax deductible?
No, stamp duty is not tax deductible.
Yeah, that's right. It's not tax deductible, but one interesting point to note is that if it's an investment property, when you go to sell the property, if you do have capital gains tax applicable, stamp duty actually gets added to the capital base of the property, of the purchase price, for the purpose of calculating what capital gains tax you'll need to pay. So the stamp duty that you've paid initially up front will potentially reduce the capital gains tax that you'll have to pay when you sell the property. If it's an owner-occupied home, your principal place of residence, then capital gains tax isn't applicable, and then it doesn't really matter. But it is really important that if the property is ever going to be an investment property, that you keep documentation around what stamp duty you've paid so that you can get those deductions if and when you sell the property in the future. Now you know all about stamp duty. Let's talk about LMI, or Lender's Mortgage Insurance. So firstly, Matthew, what is LMI and how does it work?
Certainly. So LMI, as you said, stands for Lender's Mortgage Insurance. So essentially it's an insurance or a premium that you would pay to protect the lender. So it doesn't protect yourself, but does protect the lender if your loan to value ratio exceeds 80%.
So when you say loan to value ratio exceeds 80%, that basically means that the borrower is borrowing more than 80% of the value of the property. Is that right?
Yeah, spot on.
Yeah. So one of the interesting things about Lender's Mortgage Insurance is that borrowers think that it protects them, but actually
Yes.
it doesn't, does
No,
it?
not at all.
It protects the bank.
That's right. Yes.
So, and it protects the bank in the case that you might default on your loan and they may not be able to recover all of the money that they need to recover from a sale of your property.
Yeah, perfect.
So how is Lender's Mortgage Insurance calculated, Matthew?
Yes, so Lender's Mortgage Insurance is calculated based upon the purchase price of the property, the deposit that you've got to put towards that property, and then the subsequent loan to value ratio, as we just mentioned.
So would it be fair to say that the amount you need to pay in LMI or Lender's Mortgage Insurance increases as the percentage of the loan that you're borrowing increases?
Yes, most definitely, and it does start to scale more once you go above 90%.
Yep, so between 80 to 90% it's sort of a lot more affordable, and then
Correct.
it starts to really ramp up between
Yes.
90 to 95%.
Yep.
Is LMI tax deductible?
Is LMI tax deductible? It can be on an investment property, so definitely have a chat to your tax accountant about that one.
Yes. One of the things about LMI on an investment property is that normally LMI is a cost that you can depreciate over the first 5 years of after you've purchased the property, and you can also generally claim the interest that you're paying on the amount you borrowed to pay the LMI. So there's a couple of good tax deductions in there for investment properties. Now, is LMI a one-off payment or is it an annual thing like normal insurance policies?
Yeah, so generally it's a once-off payment, so you'd pay that at time of settlement, and then that's added to the loan amount that you're taking out.
Yeah. So you've answered the question of can LMI be added to the loan amount? Well, yes, of
most
course
definitely.
it can be. And can it be refunded? Like, let's say, for example, you sell the property or you want to refinance. Some people ask, can you get a refund on the LMI that you've paid?
Generally, no. So it is a once-off payable fee that isn't refunded down the track. So if you were to refinance the property, because that's already in the loan balance, you would be refinancing that LMI as well, essentially.
Yeah. So if you wanted to refinance your loan to another lender and you've paid LMI with your current lender, what would actually happen?
So if you've paid it currently and you were to refinance to another lender, then essentially that would be void in a sense, because it has already been added to the loan amount. So when you refinance to a new lender, they would have to refinance, I guess, that portion of the LMI as well. And then assuming you're below 80% loan to value ratio, then you wouldn't have to pay it again. If you were to refinance in a period where you're above 80% loan to value ratio, you may have to pay LMI a second time.
Yeah, that's a really interesting point to mention, because if you do refinance your loan when your loan is more than 80% of the value, like Matthew said, then you may have to pay LMI again with the new lender. However, another interesting point to note is that if you stay with your existing lender but you want to increase your loan, let's say you've built some equity over a few years and you want to increase your loan back up to the original percentage, like 90% for example, you may not actually have to pay as much lender's mortgage insurance, because the amount you've already paid to protect that lender will still be applicable. So that's something that we can help workshop with you and work out what's the best option for you. When is a good time for someone to consider paying for LMI and taking that option?
Yeah, definitely. I think there's definitely some good options for that. A first home buyer would be one of those.
Yes.
I mean, the hardest part is really trying to save up 20% deposit, plus then you've got to save your stamp duty and other associated costs on top of that. So that's probably a really good time for a first home buyer to consider that. They can get into the market sooner, stops them paying rent, and then they can start putting that money towards the mortgage.
Yeah, absolutely. It makes a massive difference. If you have to save, a 10% deposit versus a 20% deposit or versus a 25% deposit, it's a massive difference,
It is.
Really, isn't it?
That could be years of saving.
That's right. And in that time, the property market's probably grown and you've priced yourself even further out of the market. So
Yep.
That is everything you need to know about LMI. But of course, the main thing that you need to know is that at Rise High, we're here to help you, and we're here to help you answer all of your questions. Anything you need to know, we're here for you. So please get in touch with us and speak to one of our friendly mortgage brokers today. Have a great day. Bye.
Bye.